Nightshades Inc.'s NSI manufactures biotech sunglasses. The variable material cost is $5.43 per unit, and the variable labor cost is $3.13 per unit. And NSI incurs fixed costs of $720,000 when total production is 280,000 units. What is the variable cost per unit, and what are the total costs for the year? To calculate our variable cost per unit, we need to add together our $5.43 material cost and our $3.13 in labor cost. The total variable cost per unit is $8.56. We multiply this variable cost per unit by the 280,000 units to get total variable costs of $2,396,800. We add to this the $720,000 in fixed costs to arrive at total costs of $3,116,800. For part 2, we're going to make use of some of our information from this first part. We remember that our fixed costs were $720,000 and our variable cost per unit was $8.56. Let's move on to the second part. If depreciation expense is $220,000 per year and the selling price is $19.99, what is our accounting break-even, and does NSI break even on a cash basis? Accounting break-even occurs where net income equals zero, and we can work backwards up our income statement to calculate our contribution margin and the number of units. If net income is zero and our depreciation expense is $220,000 and our fixed costs are $720,000, we know that our contribution margin must be the sum of these two amounts, or $940,000. We can calculate our contribution margin per unit. That will be our selling price of $19.99 per unit minus our $8.56 variable cost per unit. Finally, as a last step, to calculate our accounting break-even, we take our required contribution margin of $940,000 and divide it by our $11.43 per unit contribution margin, and we find accounting break-even occurs at 82,240 units. Our cash flow break-even occurs when our operating cash flow is zero. And again, we'll work backwards up our income statement to calculate our required contribution margin and then finally the number of units we need to break even. Recall, to calculate our operating cash flow, we take net income and add back depreciation expense, which in this case was $220. Therefore, net income would have been a loss of $220,000. Net income loss of $220,000 plus depreciation expense of $220,000 would have given us our operating cash flow of zero. Working back upwards again, our depreciation expense was $220,000, this was given, and our fixed cost were $720,000. If we add together our net loss, our depreciation expense, and our fixed costs of $720,000, we find that our contribution margin would need to be $720,000 in order for us to have an operating cash flow of zero. Recall, from above we calculated our contribution margin per unit, which was $11.43. Therefore, we can calculate our break-even point for cash flow by taking our required contribution margin of $720,000 and dividing it by our $11.43 per unit contribution margin. We find that our cash basis break-even is at 62,992 units.